Every week, two stocks hit new lows for reasons that aren't always obvious. In this series, we break down what's really driving those moves so you understand what's actually happening behind the charts. This week, the two stocks look different on the surface, but they're both tied to the same underlying concern. Investors fear the economy is slowing, and many are betting that the bubble people keep talking about is finally starting to pop. Let's see if that's actually true. We'll start with Old Dominion Freight Line, a trucking company tied directly to the real economy to see how things are really holding up. Old Dominion Freight Line is one of the largest, highest quality, less than a truckload carriers in North America. For years, they rode a strong freight environment. Their dense network and reliable service kept customers coming back, and it showed in their results. But things are shifting. Growth started reversing in 2023, and Q3 makes it clear. Less than a truckload tons per day are down about 9% year over year. Shipments per day dropped nearly 8%, and even the average weight per shipment fell. Management points directly to the domestic economy. Housing, HVAC, industrial goods are all slowing down. Fewer goods are being produced and shipped. The takeaway? Even the best freight operators aren't immune when the real economy softens. Old Dominion gives us a front row look at how macroeconomic weakness shows up in the trucking industry. Since Q4 2022, revenue has slipped from about $6.2 billion down to about $5.6 billion today. Even with that decline, Old Dominion has done a decent job defending its gross profit margins. Due to fixed overhead costs, their operating ratio ticked up to 74.3%. Still, the company is running a tight ship. Direct costs stayed flat thanks to strong operational control and smart yield management. Speaking of yield, revenue per hundredweight actually rose 4.7%. So even with lower volumes, they're making more per shipment, showing real pricing power. Looking ahead, October hasn't been much better. Revenue per day was down 6.5 to 7% versus last year. Management expects the operating ratio to rise another 2.5 to 3.5% next quarter. In short, volumes are soft, but the company is squeezing efficiency wherever it can. When it comes to valuation, Old Dominion shows the danger of investing in a stock with a high forward PE and what happens when the growth stops or falters. The stock ran hot during the pandemic, trading well above its historical 20 times forward PE. But now, with growth slowing and even turning negative, that forward PE looks way too high. I'm modeling about 2% average growth over the next 5 years. That includes a 3.5 to 5% shareholder yield from dividends and buybacks, assuming the negative trend slows and eventually reverses. Even being generous, that puts total returns over 5 years around negative 21%, with downside risk of 55% from today's price before future returns line up with the S&P. My take, this is an avoid for now. The forward PE needs to come down from these elevated levels, and growth needs to pick back up with the real economy before this stock makes sense. Of course, there are risks. The biggest is the macroeconomy. If demand for freight stays weak, volumes and revenue could fall further. Then there's regulation and ESG pressure, especially around emissions. Over the long term, failing to adapt could raise costs or hurt competitiveness. Finally, even with a top-tier network, a prolonged slowdown could challenge margins and shareholder returns. So what's the bottom line? Old Dominion is a top-notch operator with a strong network and pricing power. But volumes are soft, growth is slowing, and the stock is priced for perfection. Right now, it's a front-row seat to how a real economic slowdown hits freight. Interesting to watch, but not a buy yet. Now, let's see if this economic slowdown extends to the digital economy. The Trade Desk, or TTD, is basically the independent buy-side platform for digital advertising. Think of it like the ultimate matchmaker for advertisers. Instead of being tied to Google, Meta, or Amazon, the Trade Desk helps brands buy ads wherever they'll perform best across the open internet. No conflicts, No walled gardens, just finding the best deal for the advertiser. Right now, the tailwinds are strong. Digital ad spend keeps growing, and connected TV is booming across streaming shows, apps, and podcasts. That's the fastest growing slice of their business, and advertisers are flocking to it. But 2025 hasn't been all smooth sailing. There's macroeconomic uncertainty and some caution in the ad market. Growth is still happening. Revenue's up and margins are solid. But the pace isn't as explosive as it used to be. So you have a company with huge scale, strong tech, and secular tailwinds. But it's navigating a market that's a bit choppier than usual. Financials tell a pretty clear story. The trade desk is growing, just not at the pace analysts had gotten used to. For years, revenue regularly grew 25% or more. Now, we're looking at 18% year over year, or 22% if you strip out political ad spend. Still strong, but not the hypergrowth some investors were banking on. Net income is still growing extremely fast too, over 40% year over year, even if that growth rate is also slowing. Adjusted EBITDA hit $317 million for a very healthy 43% margin. In other words, even as the top line growth cools, the business remains highly profitable with strong operating leverage. The scale advantage is real too. The trade desk processes billions of ad impressions every day, on the same order of magnitude as credit card networks. That massive data set is what fuels their AI engine Kokai, and the results are obvious. Cost per acquisition is down 26%. Cost per unique reach is 58% better. Click-through rates are almost double. So, despite a choppier macro environment, the fundamentals are solid. Revenue is growing, profits are still expanding quickly, margins are strong, and their tech advantage continues to widen. The trade desk is still running a massive, highly efficient business, just at a more mature growth rate than before. When it comes to valuation, the trade desk actually looks a lot more interesting today than it did a year ago. The fundamentals are still strong, but the company is clearly maturing. And you can see that in the numbers. The forward PE used to be massive, over 70 just last year. That multiple has compressed all the way down to around 19, and that's put pressure on the stock. But here's the surprising part. Even if net income growth keeps decelerating by about 5 percentage points a year, the trade desk would still be growing net income at roughly 20 to 25% annually. And at a forward PE of 19, you're also getting around a 5% shareholder yield baked in. When I plug those assumptions into my 5-year valuation model, using about 25% total growth, including yield, I end up with a 207% return over 5 years and roughly 74% upside from today's price. That's compelling. So, my take is simple. This is a company worth digging into further. I might consider buying it if recession fears ease or if we actually enter a recession and the stock gets even cheaper. Of course, there are real risks here. First, the trade desk is tied directly to the health of the advertising market. If the economy slows further, ad budgets get cut fast. Second, big tech is always a threat. Google, Meta, and Amazon each control massive platforms, and any changes to their systems can ripple through the open ad market. And finally, valuation risk still exists. Even with the multiple down to 19, if growth decelerates faster than expected, this stock could re-rate lower. The trade desk isn't the hyper-growth story it used to be, but the fundamentals are still strong, the valuation finally makes sense, and the long-term setup looks compelling. This is one I'm watching closely for the right entry point. So what's the real story with the economy, and are these bubble fears justified? Looking at these two examples gives us a clearer picture. Old Dominion Freight Line shows the real, tangible impact of a slowing economy. Shipments are down, growth is soft, and costs are harder to manage. That's the warning sign for investors who think the slowdown is only abstract. Meanwhile, the trade desk shows a different side of the story. Even with macroeconomic uncertainty, strong fundamentals, AI-driven efficiency, and secular tailwinds in digital ad spend keep growth alive. The economy might be slowing, but innovation and high-demand sectors can still deliver upside. The takeaway? A slowing economy doesn't mean everything collapses, but it does matter which businesses you pick. Investors need to separate story from reality and focus on companies that can either weather the slowdown or ride long-term growth trends. If this analysis was helpful, please hit that like button. And since you stuck around to the end, join me on Discord. I'd love to answer any questions you have. Thanks. Bye.